America's national debt is no longer a number. It's an experiment. Right now, the United States owes over $41 trillion. That's more than the entire U.S. economy produces in a year, more than every company, every worker, every household will create this year, already spent. Every time we slam into the so-called debt ceiling, Washington runs the same script. Panic, emergency hearings, threats of shutdown, speeches about tough choices. Then they raise the ceiling, or suspend it, or push the problem a few more years down the road. A ceiling you keep moving stops being a ceiling. It becomes a trap. Meanwhile, the surface story still looks calm. Stocks are strong. Big tech and AI names are ripping. Corporate profits look okay. Unemployment is low. Wall Street keeps repeating the same comforting line. America's always managed its debt. It'll be fine this time, too. In this video, I want to walk you through a different lens. Why 41 trillion isn't just one more milestone. Why the debt ceiling has quietly stopped meaning anything real, how this becomes a long experiment in financial repression, and what that means for your savings and your future. This isn't about left or right. It isn't about which politician you like. It's about arithmetic. And arithmetic doesn't care who you vote for. So let's start with the math, because everything cracks from there. America's economy, GDP, is in the high 20 trillions. The debt is in the low 40 trillions. Debt is already well above 100% of GDP, a zone where countries historically start running into structural trouble. But the level is only warning number one. Warning number two is speed. Every year, the U.S. government spends far more than it collects in taxes. The gap, the deficit, is now measured in trillions, not billions. Sometimes close to $3 trillion of new borrowing every single year. Now stack interest on top. When interest rates were near zero, you could pretend this didn't matter. You could roll over debt, issue more, and the interest bill stayed faint in the background. Not anymore. With today's rates, interest on the debt has exploded. The government is paying hundreds of billions, heading toward over $1 trillion a year, just in interest. Interest is now competing with the biggest programs in the federal budget. Before a single road is built, before a single teacher is paid, before a single soldier is funded, the government has to write a massive check just to service what it already owes. And as the debt grows, that check grows. Project the current path, and the picture is simple. Debt moves from the low 40s into the high 40s, then the 50s. Interest costs edge toward taking a fifth, then a quarter, then close to a third of all federal tax revenue. That's not a policy debate. That's a debt trap. You can call it managing the national balance sheet. You can call it modern finance. But zoom out and the shape is always the same. More and more of what the country earns gets redirected to bondholders, just to stand still. Countries in this position don't discover a magic fifth option. They have a short menu of ways out. Option 1, grow faster than the debt. The dream scenario. The economy booms, productivity jumps, tax revenues surge, and debt grows more slowly than GDP. So the ratio falls over time. After World War II, that's roughly what happened. High debt, but even higher growth and low interest rates. Today, that path is much steeper. Manufacturing is smaller, the population is older, boomers are retiring, structural growth is slower, and after a decade of zero rates and bubbles, there's not much room to cut again. Option 2, inflate the debt away. Let inflation run hotter than interest rates, so prices rise faster than your official borrowing cost. On paper, the debt shrinks. In reality, retirees, savers, and wage earners pay through lost purchasing power. Option 3, default. Stop paying openly or by stretching and changing terms. For the country that issues the world's risk-free asset, that would be an earthquake. Every pension fund, bank, and central bank is built on the assumption that treasuries get paid. Option 4, financial repression. Quietly rig the rules. Hold rates below inflation, push banks and pensions into government bonds, block easy exits into better assets. On paper, every bond is honored. In real life, you're repaid in watered-down dollars. None of these paths is clean. Growing out demands discipline and luck. Inflation hurts the vulnerable. Default blows up the system. Repression slowly eats your future. That's what a $41 trillion experiment really is. Not fire tomorrow, but a long decision about who carries the cost. Now, if you listen to politicians, you'd think this is easy to fix. We'll raise taxes on the rich. We'll cut waste, fraud, and abuse. We'll reform the system. These lines sound powerful in speeches. They poll well. They give everyone a villain to blame. But when you put real numbers on them, the story changes fast. Start with tax the rich. If you seriously raise taxes on high earners and corporations, you can maybe bring in a few $100 billion a year. Hundreds of billions sounds huge, until you set it next to a deficit measured in trillions. If your annual shortfall is around $3 trillion, and your big tax package realistically closes 300 or 400 billion of that, you've covered maybe 10 to 15% of the gap. The rest is still there. And that's before behavior changes. High earners move income, use loopholes, shift investments. Corporations move operations or profits. What about cutting spending? In speeches, this is always about waste and fraud. In reality, the big money sits in the big programs: defense, healthcare, social security, and interest. You can't cut interest. That's non-negotiable. Slash defense dramatically, and you hit national security politics. Cut Social Security and Medicare hard, and you hit older voters who turn out at the highest rates. Squeeze healthcare and social programs too much, and you trigger another set of crises. So in practice, most of what actually gets cut are smaller, weaker items. Infrastructure projects, research funding, support programs with no powerful lobby. You save tens of billions here, maybe 100 billion there. In a world of multi-trillion-dollar deficits, the slope of the line barely moves. So the honest description is this: raising the ceiling isn't a one-time emergency measure anymore. It's the business model. The plan, whether anyone says it out loud or not, is to keep the experiment going for as long as the bond market lets them. What makes this so dangerous is that, on the surface, it still doesn't feel like a crisis. Not yet. Turn on any financial channel, and the story is familiar. U.S. stocks near all-time highs, AI and tech leading the charge, corporate earnings beating expectations, consumers still spending, unemployment near multi-decade lows. Major banks publish year-ahead targets that assume modest growth, tame inflation, and a gentle path for interest rates. The phrase soft landing is everywhere. The message is simple. Yes, the debt is big. Yes, the numbers sound scary. But the dollar is still the reserve currency. Treasuries are still the safest asset. We've always managed before. Relax. There's just one problem. Every one of those bullish forecasts comes with fine print. No serious recession, no major policy shock, no significant loss of confidence in treasuries, no inflation flare-up that forces rates sharply higher. In other words, the market is priced as if the $41 trillion experiment never really gets tested. History says that's not how this works. As long as investors keep buying U.S. debt at reasonable rates, the show goes on. As long as foreign central banks hold treasuries, as long as pensions and banks treat them as sacred collateral, the ceiling can keep moving. But the higher the debt climbs, the more sensitive everything becomes. A 1-point move in interest rates can add hundreds of billions to the annual interest bill. A mild recession can blow out the deficit by another trillion. A single policy mistake can shake confidence in a way that's hard to reverse. So the real question isn't, does America default tomorrow? It's, what happens when a very normal recession, or a geopolitical shock, or a loss of patience in the bond market collides with a $41 trillion balance sheet? To really see this, you have to think in timelines, not headlines. So here's one possible path for the next decade. Not a prediction, a scenario. Phase 1, more of the same. Congress fights over the ceiling, then raises or suspends it. Crisis averted. Markets sigh with relief. Maybe the Fed trims rates to support a slowing economy. Indexes bounce. Commentators say the worst is behind us. Underneath, debt and interest costs keep grinding higher, and the budget keeps tilting toward mandatory programs and interest. Phase 2, the first stress test. A global slowdown, a domestic recession, an energy shock, or a political standoff hits. Tax revenues fall, safety net spending rises, and an already huge deficit blows out further. Bond investors start asking harder questions. They demand higher yields. A few treasury auctions show weak demand. Rating agencies issue negative outlook warnings, not because default is tomorrow, but because the long-term math looks bad. Markets wobble. Stocks drop 15-20%. It's sold as a healthy pullback. Dip buyers rush in. People tell themselves we needed this reset, but the experiment has changed. Phase 3. Fiscal dominance. Interest costs are heavy, growth is softer, and investors want more yield. Let yields rise and interest devours the budget. Cap them with central bank buying and you risk more inflation and a weaker currency. Either way, the needs of the Treasury start to dictate what the central bank does. From there, you see the pattern on repeat. Mini crises around debt issuance, Emergency interventions, inflation occasionally above rates, and rules that quietly push pensions and banks into more government bonds. No single boom moment, just a slow, visible shift in who the system is built to protect. So what happens to actual assets in a world like that? Start with treasuries, the thing everyone still calls risk-free. On paper, they stay free of default risk. The government pays what it promised. But if inflation runs hotter than yields, you lose purchasing power every year. No dramatic blow-up, just a slow leak. For big institutions, pensions, insurers, banks, regulation can make this unavoidable. They're pushed to hold more government bonds and are told this is safe. Safe from big price swings, not safe from erosion. Then there are stocks. In the early stages, they can look amazing. Easy money, stimulus, and AI hype push valuations higher. Narratives matter more than cash flow. Later, as debt service eats more of the budget and growth gets more fragile, risk flips. Higher rates mean higher discount rates. Higher inflation makes future earnings fuzzier. Higher policy volatility means more surprises. Expensive growth names, priced as if cheap money is forever, are first in line to get hit. Real estate faces its own trap. High debt and repression can keep nominal prices elevated. Money has to go somewhere. But higher mortgage costs and stagnant real incomes drag on demand. You get assets that look pricey on paper, but don't deliver the lifestyle people imagined. Then you have gold and other hard assets. Gold doesn't care who's in office, it doesn't have earnings, it doesn't default. In panics, it can sell off with everything else. But when the core problem is trust, in currencies, in bonds, in promises, gold tends to get repriced higher over time. A similar but more volatile pattern can show up in scarce digital assets like Bitcoin. They trade like tech on the way down, and like a hedge if the crisis turns into a deeper currency and trust problem. The key point is simple. In a $41 trillion experiment, old labels like safe or risky don't tell the whole story. The real question is who's carrying the cost. And that brings us back to you. For most people, this isn't about yield curves and rating outlooks. It's about whether the life they planned is still possible. If you're nearing retirement, this experiment hits you through your savings. Your money is probably in some mix of stocks, bonds, and real estate, directly or through pensions and retirement accounts. On paper, the number may look fine. You may have spent decades doing everything right. In a world of higher inflation and lower real yields, the question becomes, how far does that number actually stretch? If your portfolio grows at 4% nominal, but your true cost of living, healthcare, utilities, services, taxes, rises 5 or 6%, you're moving backward. Not in a dramatic crash, but in a slow drift where 10 years later you think, I'm not broke, but I'm living tighter than I expected. If you're a homeowner, you sit in the crosshairs. High prices can make you feel rich on paper, but higher rates, taxes, and maintenance eat into your budget. Buy late in the cycle with a big mortgage and a long stretch of flat or falling real values can leave you stuck, unable to move or refinance, watching your equity feel less like freedom. If you're still in the workforce, especially in the middle, the experiment feels like a squeeze from both sides. Wages move slowly, core expenses move faster. Job security is shakier in a world of automation and cost-cutting. At the same time, the safety nets you counted on, pensions, benefits, public services, are the same systems being stressed by the debt. This is how a macro experiment turns into personal stress, not with one headline, but with a constant erosion of options. So where does this leave us? On one path, the optimistic one, the $41 trillion experiment never fully blows up. AI delivers real productivity gains. Policy avoids major accidents. Growth muddles through. Inflation stays roughly under control. The dollar stays dominant enough. The bond market keeps cooperating. Debt is heavy but manageable. There are scares and corrections, but no full reset. Households feel squeezed, yet the system survives. On another path, the experiment ends messier. A normal recession hits on top of huge debt. Growth slows while interest costs rise. Central banks keep stepping in. Financial repression stops being theory and becomes policy. Confidence in treasuries erodes. Stocks suffer a true bear market. Housing delivers years of flat or negative real returns. The dollar weakens faster. Wealth and risk get repriced the hard way. You don't have to assign a 100% probability to that second path to see the problem. You just have to compare the payoff. A little more upside if everything goes right versus deep, long-lasting damage if even part of the downside shows up. That's why this isn't really about predicting a crash date. It's about whether you take the math seriously. You don't control what Congress does with the ceiling, how much your government borrows, or when the bond market snaps. But you do control whether you treat this as background noise or as the experiment you're already inside. This is not personal financial advice. I'm not telling you what to buy or sell. I'm telling you the ceiling has stopped being real, and pretending it still exists is the most dangerous bet you can make. The experiment has already started. Your only real choice is whether you sleepwalk through it